Hi, you're watching Your Future, Your Finances. I'm Brian Kuhn. Today we're talking with Jeff Merwin about the topic of long-term care insurance and planning. Thanks, Jeff, for coming on the show and being back with us.
Thank you.
So last segment we talked a little bit about it. I want to talk a little bit more about what a typical long-term care insurance policy looks like, and then some alternatives to the traditional form.
I equate it to a good waiter.
Mm-hmm.
You know, a good waiter is going to bring you a couple of options as far as your dessert at the end of the meal,
Mm-hmm.
as opposed to saying yes or no, do you want dessert?
Right.
And so we try to bring to the client, you know, the traditional long-term care, which as we referenced before, has the traditional monthly benefit, the pool of dollars, the inflation on it, etc. It is a use it or lose it situation, but it does have very attractive features and riders to help for that. Another very popular product has been plain old life insurance,
Mm-hmm.
but we've added a long-term care rider on top of that, simply saying we're going to make the death benefit that you purchase, let's use an example of $500,000,
Mm-hmm.
but we're going to allow you to access that for long-term care as well. So maybe 2% of the face amount would be available to that person to accelerate first before death occurs.
Okay.
So either way, they're going to use the benefit one way or another, and that's an attractive way of doing it as well.
Mm-hmm.
Thirdly is for some who, what we call, have lazy money sitting around. This might be someone who has a CD off the side kind of for that rainy day situation, kind of wondering if maybe that's what I'll use to cover the cost of care.
Mm-hmm.
We're simply saying reallocate or reposition that CD into an insurance product that would do three things. Number one, let's take an example of $100,000. We would switch that over into an account that would still earn interest, just like it was on a CD, would still stay liquid. Secondly, would provide a death benefit, typically 1.5 to 2 times more, depending on the age and the gender of the person making the transaction.
Mm-hmm.
And then thirdly would be create a long-term care account. It might be 3 to even 7 times more. So for instance, a young female would get a lot more coverage than, let's say, a much older male, just because of the makeup of the person there.
Mm-hmm.
But that way they could get, their 100,000 would get them 5, 6, 700,000 of long-term care protection. So that way the ratio of coverage to premium is very attractive.
Without an ongoing bill.
It's a once and done deal,
Mm-hmm.
absolutely. So that's seen a lot of popularity and growth for those that can utilize that.
Mm-hmm. So you have all these new forms of insurance, and then you have some older policies. People got it when long-term care was just coming out as a form of insurance, and they're getting letters with rate increases. What's going on with that?
Well, I think the easiest analogy I came up with was the gallon of gas. So for some of us, we can remember when a gallon of gas was 75 cents a gallon.
Mm-hmm.
And these folks are being asked to now pay $1.50 for a gallon of gas.
Mm-hmm.
You and I, who are at the pumps today, would say that's a bargain.
Mm-hmm.
It's a weak metaphor, but I think the idea here is that the assumptions of those older policies were because the industry itself was fairly new.
Mm-hmm.
And we just didn't have the same kind of data that we have today.
Mm-hmm.
And I'll give you 3 examples. One is a lapse rate. Most of the companies had about a 6 or 7% lapse rate. That means out of 100 people that buy policies, they guessed that about 93, 94% would hold on to them.
Sure.
Guess what?
Not that much.
It's 99% hold on to the policies. So with a 1% lapse rate, that means a lot more people are going to be holding on to the policy and using it and having a claim. So the industry realized that that policy series is underfunded, and we need to ask for a rate increase.
Mm-hmm.
The second element is rate of returns. Interest rates are at an all-time historic low for the most amazing long period of time.
Mm-hmm.
And the safe markets that carriers have to invest in are just not getting the returns that they thought they would
Mm-hmm.
when those policies were set with a conservative estimate of 6 to 7%. Now they're getting closer to 3%, and that's just not enough to sustain the policies. And fourthly is just underwriting. Years ago, underwriting was much more lenient. They would accept certain health risks. Now that we've hit the claim wall, meaning we know people, what conditions result in claims, much
Sure.
better feel for that, we get a sense of, okay, we know how to underwrite better today than we did back then. So underwriting is more stringent now. And so those 3 elements they have a better feel for. I have a lot more confidence that today's policies are priced more accurately and correctly would not see the wild kind of shifts in premiums of the older policies before.
Seems like an industry going through a lot of change.
A lot of change, absolutely.
What are some other changes going on? We have pricing and some other things you were talking about.
Well, one of the recognitions we've seen is that the claims people are talking to the underwriting people and the pricing people, and they're realizing, okay, who's going on claim? Well, visit any retirement community, and many of us have family and so forth there, and you'll recognize that there's a predominant gender there.
Sure.
Females drive a lot of the long-term care, and as my 96-year-old dad would say, Jeff, it's a bad age to get such good odds. So we find that females are the heaviest utilizers, and so this past year, the industry has gone to driving with more a differentiation in pricing. So we call it gender pricing. And the truth is, women now pay much more, 50 to 75% more than men do. They kind of kept the rates the same for men, but they really boosted them higher for women because they're the higher utilizer. Interestingly enough, you can't do that in the employer market space. Just the way you'll see if you were to buy supplemental life insurance through the workplace, it's unisex pricing for life insurance, which benefits the guys. In the case of long-term care, we've got unisex pricing for females, and so there's a tremendous advantage there. And so that market space is going to grow, I think, a lot more in the future as well.
The group long-term care through an employer.
Absolutely.
Okay.
Sure.
All right, we've been talking with Jeff Merwin of Capital Metro Insurance. A lot of information for our viewers today. That's going to do it for today's episode of Your Future, Your Finances. Again, I'm Brian Kuhn. Thank you very much for joining us.